Million Dollar Baby webinar. My name is Marlena Smith. I am a field director with our Infinite Company, and the Million Dollar Baby Plan is one of my favorite plans. It's how I was introduced into financial literacy, financial services, and it really gave me peace of mind at a time when I was very overwhelmed as a new mother. So we also refer to this plan as a Million Dollar Legacy Plan because it's not actually only for babies and children, right? It is for adults as well. Kimberly and I are also Million Dollar babies, but we are so passionate about sharing this information and this tool with parents and grandparents and guardians because we understand the power of time, right? Did you know that time actually matters more than money? You guys ever heard that before? We're going to show you throughout this presentation today. We're going to share with you a concept, right? It is nicknamed the Million Dollar Baby Plan, but it's really about just a simple idea of starting early and using the right financial tool. So I am excited for tonight's call. I hope you guys are too. Welcome to the call, Mr. Jones. We're happy to have you here. But if you are able to turn on your cameras, we would love to see your faces, interact virtually. We understand things are going on in the background, so we are happy to have you here regardless. And then if you don't already, please take out a pen and paper so you can take notes. We're going to be sharing some amazing information tonight. And then also, while you are listening to this information, if somebody comes to mind that you think can benefit from this information as well, jot their name down and let the person know that invited you or invite them to next week's call. We do this every Wednesday. It is at 6:30 Pacific, 8:30 Central, 9:30 Eastern. So our East Coasters that are on, thank you for coming on, even though it is late in the evening. So before we get started, though, talking about the Million Dollar Baby Plan, we're going to talk about some current financial realities, okay? Because here at our Infinite Company, our mission is to empower people through financial education and entrepreneurial mentorship. So before we dive into the plan, we have to look at what's going on in our world, right? What are some current financial realities? So number one, it says 60 to 70% of Americans live paycheck to paycheck. Okay. We've been talking a lot about how mental health and financial literacy are so closely related, right? And if you're living paycheck to paycheck, you guys don't see my screen? Please tell me, Kim.
I just text.
Sorry, thank you. That's funny.
There you go.
We're good?
Yes, ma'am.
All right. There wasn't much to see before this. So thank you, Kyrie, for letting me know. The next one we have on here is 47% cannot afford a $1,000 emergency without borrowing or maybe having to put it on a credit card, right? So if you have a few flat tires, one of my mentors used to say, it's only an emergency because you don't have money, right? A lot, not it's only, but majority of emergencies are only because you don't have the money, right? So if you have two, three, four flat tires that you need to replace and you don't have the money for that, it becomes an emergency, right? You can't get to work, you can't get your kids to school, you can't make it to your appointment, you have to a few more hours of travel time, right? That feels like an emergency. Whereas if you have that money to pay it, it's an inconvenience, right? The average American household has a debt of 104,215 on average. The average college graduate owes about 37,853 in student loans. Kimberly can attest to that being much higher, right? The average monthly Social Security benefit for 2025 was 1,976 per month, right? So that's less than 24,000 per year. And the average 403(b), 401(k) account is 240,000 by age 60, which maybe to some might not sound that bad, but with life expectancy being until 83, 85, is that 240,000 going to be able to cover the next 20 plus years? Okay. And then the average person will change careers every 4 years, even less time amongst those that are 35 and younger. right? So that 240,000 401k balance, that average is quickly dropping because people are not staying in their careers enough to fund their 401k, right? Or they're there for a year, it has a couple of thousand, they cash it out. Go to another job, it has a few thousand, cash it out, right? That becomes their emergency fund, but no, they're not saving for retirement. So these are some realities that we are facing here, right? So tonight we're going to focus on giving our children a better financial head start. We're going to discuss how to guide them into adulthood where they don't fall into these statistics and they start with the right habits and the right strategies for a strong financial future. So, as it says on here, it is time to change generational curses into generational wealth. So, that leads me into this $1 million baby plan that we are going to be talking about tonight. Let me make sure the sound is sharing and then I will share this video. It's a quick 2-minute video that summarizes what this plan is, and then myself and Ms. Kimberly Howard will go a little bit deeper into the details and benefits of this plan.
A pretty money savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Right. So wasn't that video, it basically summarized this $1 million baby plan. Every time I see it, I get really excited to hear the information. I actually followed the instructions exactly. I put $100 a month for my children into account when they turn on their income at age 65. I started, see, time matters more than money, right? We talked about in the very beginning in the video, they started their child right when they were born. We can start as soon as a person has a social security number. I started my daughter's plan when she was 4. So her lifetime income was about 68,000 instead of 75. So just those few years made a difference in her income if I do exactly the same thing. Okay. But this $1 million baby plan, it uses what's called an index universal life insurance policy, which is a financial strategy designed to build generational wealth, right? Again, why we love sharing this with parents and grandparents. It involves purchasing an IUL policy for a child at a young age, funding it over time to accumulate that cash value. And the goal here is to create lifelong financial benefits, including tax advantage growth, a death benefit, and the ability to borrow against a policy for major life expenses. Okay. So those are just some key things about the plan. what are the top three benefits of the Million Dollar Baby Plan, right? The number one is that cash value growth, right? So a parent or a grandparent or a legal guardian can open one of these plans for their children, an IUL policy, and the premiums are paid into this policy, which grow in cash value. And it's based on an index interest strategy, right? I try not to get tongue-tied when I say that, right? Index interest strategy. For example, like the S&P 500, and there are things called performance with cap and a floor, right? But to really understand this cash value growth, we need to understand how our money grows, right? What are the different options for our money to grow? So the first way for our money to grow is fixed. Okay. So fixed, you're earning a guaranteed interest rate. Your risk level is low. Your money is safe and guaranteed not to lose because it's not tied into the stock market. But the growth potential is pretty minimal. If you know your interest rate at your bank in a savings account, it's usually 0.01, 0.02%. Okay, so very minimal growth. Maybe you can get a CD or high yield savings account for maybe 3, 4, 5%. But again, it is a guaranteed rate, low risk, but not huge upside potential. Okay. For variable, this is when um, your earnings, excuse me, are based on the performance of the stock market. So the risk level is higher because you do have great potential for growth, but you also have high risk for loss when the market drops. Um, so these would be your 401ks or 403bs, IRAs, or directly investing in stocks. Okay. The index offers a balance of that growth potential and that protection that you get from the fixed, right? So the earnings here are mirrored in the stock market, like the S&P 500, but you don't actually invest directly into the market. So the risk level is more moderate. Excuse me. There is a cap and a floor. The floor is the most important part, though. The floor oftentimes is 0%. So what that means is if we look at this here, when the market drops 20%, worst case scenario for you, your floor is 0%. So worst case scenario, you're not making any money, but you are not losing. Okay. And the risk of loss is much bigger than people realize. So not losing that 20% and having to make it back before you are profitable again is a very huge benefit. So in these plans, this is what is used as index interest strategy. So I heard an analogy of it that I really liked, that it is like a safety net, right? That lets you ride the waves of the market, but with a really good life jacket on, right? So you still get to participate in the market, benefit from those gains, but you're not going to sink. Okay. So that is what an index interest strategy is. The next benefit of a Million Dollar Baby Plan is the tax advantages, right? So maybe when you first heard index universal life insurance, you thought, why life insurance? Well, a big reason why life insurance is because when cash value is tied into a life insurance contract, there are tax advantages, right? There are tax advantages, tax deferred growth, tax-free access to your funds, okay? And then later, your child can access that cash value through, again, tax-free loans for either education, for buying a home, a new car, whatever it may be. It doesn't have to be a specific thing that they use it for, but also they can use it for planning for retirement. So we will show you some real illustrations a little bit later so you can see how that can work. The third benefit, which is one of the most important, right? I don't know if you guys have thought about it before, but I highly recommend you take a moment and think, what type of legacy do I want to leave on this world, right? Not just financially, but finances are a big part of what we are able to do. But what type of legacy do you want to leave in your family, in your community, and in this world? Okay. So through an index universal life policy, we're not just talking about protecting a life, we're talking about creating a legacy that can last for generations. So as your child grows older, they can continue funding the policy and allow it to keep building cash value over time. Again, the illustrations part at the end is my favorite, so definitely make sure you stay on so you can see when Miss Kimberly Howard goes over the illustrations and really shows you what that cash value growth can look like. Okay. So the child can continue funding, and then upon their passing, right, upon their passing, they'll leave their beneficiaries with a tax-free death benefit. And if it is structured and funded properly, that can easily be millions and millions of dollars. Okay. So we are truly talking about leaving a legacy for our children's children's children, right? So if you can imagine, what if your family had something in place like this, and when they passed away, you inherited or you um, were passed down $2 million, $3 million, $5 million. How differently would you approach the world? How differently would you approach opportunities and jobs, right? You would choose from what you really love to do because money is not an issue. So that is what I hope for my family. Again, think about what you want to leave as a legacy and how you would like your children to continue it. And this $1 million baby plan can really help you achieve that goal. So we're going to talk about a few different things, right? Those were the top three benefits, that cash value growth, the tax benefits, and that wealth transfer and legacy building. But if you guys are like me, when I first had my child, I was looking at all types of things. I'm like, how am I going to save? How much do I need? What college, how much is this college? How much is that one? And just really going over all the numbers in my head and thinking, how do people do this, right? How do people do this? Thankfully for me, I had family who came to visit my baby when he was 1 month old, and they shared this exact information with me. And in that moment, I was able to take a deep breath and say, okay, I feel like at least in one area, I got this, right? The rest of it, I'm still figuring it out, but planning for his financial future, I got this. Okay. But before that, I did look at different accounts, like a high yield savings, 529 plan. And then I was introduced to this $1 million baby plan. So if we're comparing other plans to this IUL, there are eight these features here. I think this is eight or nine. These are the top features that people typically look for when choosing long-term savings and investment strategies, right? And you can let me know if you agree, if these are things that you look for also. Number one, of course, is growth potential. Okay, so the ability to increase your money over time. That's what we're all looking for when we're looking for an account for our children's future, right? Safety and protection. Is it protected against major losses, market crashes, things like that? Does it have tax advantages, right? Is there opportunity for tax deferred growth? Is there tax-free access? Does it reduce my taxable income? What type of tax advantages do these accounts have? You want to know about liquidity, right? The ability to access your money when you need it for an emergency or maybe for an opportunity or a life event. When can you access your money? That's an important part to look at, important feature. And then guaranteed benefits, right? So features that provide certainty, such as guaranteed death benefit or guaranteed income for life or principal protection that you're guaranteed to never lose a penny. Flexibility, so that is pertaining to your contributions, right? Can you adjust your contributions if you only want to put money in for a certain amount of time, if you want to increase it over time, where you're allocating your investments, different withdrawal strategies, you have flexibility there. Legacy and wealth transfer, we talked about a bit, but your ability to leave money behind for your children, for your family, for future generations. Is that feature available? And then protection against inflation is the interest rate outpacing inflation. And then the last one that was discussed in the video, right, is does not affect financial aid. So when we're looking at a high yield savings account, it does have growth potential. It does give you some safety and protection. You can generally access your funds in a short period of time. And then you have flexibility on how much you're putting in there, right? You don't have to put a set amount every month. But as far as the other ones, not really tax advantages. There's no additional benefits tied into it. You can leave it to the next generation, but it's just whatever you have in there. And then protection from inflation, this one could possibly be a check mark depending on the percentage, but as we've seen lately, that inflation rate is increasing. and then does not affect financial aid. If you do have money in a high yield savings account, it will count as an asset if you're applying for financial aid. Okay. For 529 plan, again, has growth potential. It does have safety and protection, some tax advantages, right? You're going to put in post-tax dollars, so you will have tax-free access in the future. There is some legacy and wealth transfer, but it has to be specific to education. So a 529 plan is designed to save for education, for college, right? So if your child does not go to college and they choose to be an entrepreneur or take a different route, that money in there either needs to be used for another child for college. You can use it for yourself for college. You can pass it down to the next generation, but again, it must be for education. And then protection against inflation. The rates on these have generally been higher than inflation. So that part is checked off. But again, if you do have a 529 plan and you want to apply for financial aid once your child is ready, this will show as an asset and could potentially um, get you denied for financial aid because it will show that you have funds available. And $1 million baby plan, this is what I was looking for, right? When I was looking and I had my first child, something that checked off all the boxes. So when I saw this, I was confident that this was the right choice for me. It had that growth potential, safety, so I'm not worrying about or having to watch the market on if I'm going to lose half of my child's savings. There were tax advantages that I didn't completely understand at the time, but I am grateful for now. Liquidity, I was able to access that money for him if I needed down the line, as long as there was cash value in there. The additional benefits, the death benefit, there are also now what's called living benefits available for our children, which is amazing. Flexibility, I can choose to pay into it for 10 or 20 years and then stop, or I can pay all the way until she is retirement age. She can take over the payments. There's flexibility there as far, and also when you can access and withdraw that money. So unlike a 401k or an IRA account, you have to be 59 and a half to access your money, or you will incur penalties, right? Along with the taxes you have to pay, you will also incur penalties. The legacy and wealth transfer we talked about, protection against inflation, this definitely has that. The average over the last 20 years is almost 14% in one of our plans, so definitely outpacing inflation. And this one right here is does not affect financial aid. So the wealthy have been doing this for decades. They start a plan like this for their child, pay into it while they go to college. They apply for that financial aid. Let them use the financial aid while their money continues to grow and compound. And then once they're done, they use that cash value and pay off their loan so they're not starting adulthood with debt, right? So just minor adjustments can make such a huge difference in how we're setting up the world, right? Our children for the world. So I'm going to pass this on. I feel like I have talked your ears off. Hopefully, it was some good information for you guys. But I'm going to pass the call to my sister, my business director, Ms. Kimberly Howard.
Amazing. Wasn't that valuable information, you guys? Put an 8 in the chat if you're ready to start $1 million baby. I'm ready to start another $1 million baby. But with the information that she shared, right? What are the benefits? So overall benefits of this plan is one, as Miss Marlena said, is the tax advantage growth, right? Who I hate paying taxes. So this is a way where the wealthy people learn how to get away from taxes, right? Two, market protection. She talks about the index funds and variable, right? How is your money working for you? Do you know how your money is growing? So within IUL, the gains are capped, but there's a floor to prevent losses. So you never have to worry about if a 2008 crash is going to come or 2022 right after COVID, right? Legacy and death benefit. This provides financial security for future generations. So, one thing that I always say is guarantee you guys, hey, we all got to pay taxes. And two, we're all going to pass away one day, right? So, why not put that protection in place while they're young? Because there's also cheaper, right? Life insurance is cheaper when you start with your kids, but It provides generational wealth, okay? And then flexible access to funds. So as Miss Marlena shared right in the video, it's not just for college funds, but what if they're an entrepreneur? What if they want to buy a house? So loans can be taken tax-free for major life events and expenses. And then contributions. At the end, the contributions will come back to you. So we're going to show you an actual example of my son's policy, um, one way or another, right? The cash value, living benefits, the income, right? Or the best death benefit, God forbid they pass away. So how do I set up $1 million baby plan for my child? Um, One is really you got to choose a reputable insurance company. Okay, look for insure that with strong financial ratings, A plus or higher. um, Kind of like if you're going on Amazon, right? I always look at 5 stars, making sure that, hey, this item is it, right? But with our company, luckily, um, we only deal with A-rated companies, and one of our flagship companies have been around over 176 years. So they've been through the recession, they've been through depression, and their motto is never lose a penny. So they never lost anyone's money. So that's a good thing, right? And then two, you have to really work with someone that knows how to structure the plan properly. And this is so important, you guys, right? Because there's ways on how to structure these things based on your goals, your children's goals, right? And your generational goals. So the parent or guardian, they own the policy. Okay, because obviously the child is not able to pay the policy yet, right? So you, as a parent or a grandparent or a guardian, you own the policy until you're like ready to, give it to them and really teach them, right? Child is the insured. So the child is the one that's going to be protected from the policy, and then choose a coverage and funding strategy that maximize long-term cash value growth. That aligns with all of your goals. So we, as a financial professionals, we do have a license, so we help you structure these plans properly. Understand growth and protection features. So market index growth potential, like Miss Marlena has mentioned, right? Like an index, a S&P 500, downside protection with cap and floor strategies, and tax advantage loan withdrawals options, and understanding riders for future insurability and long-term care. So I will go over that as we go over my son's policy, and then apply and fund the policy. So once it gets approved, right, we want to, well, we help you apply. So we're not going to just give you a 20-page application, say, hey, Miss Marlena, you fill this out. We actually go through the steps with you every step of the way. Um, for children, there is minimal underwriting. So they don't, it gets approved usually automatically or within 24 to 48 hours. If they do have some kind of medical concern, then it usually takes a week or two. Okay, but we update you on the process. And then you begin funding early to maximize compounding growth. So you want to make sure that, hey, that you're funding this. And then, as Miss Marlena said, one thing that our children have is time, right? Time is important because, hey, they have this time to compound their money. And then policy ownership can be transferred to the child in adulthood. So when they are an adult, you can actually transfer this benefit to them. Give me 1 second, you guys. My son.
See my nephew there acting like you're a jungle gym. So there is a scripture, right? It says to train up a child in the way he should go, even if
Yeah.
he is old, he will not depart from it. So that is our goal with this plan. We want to make sure our children know this information moving into adulthood. So Kimberly is going to go over some illustrations.
Perfect. Thank you, Miss Marlena. Yes, my son was using me as a jungle gym. So that is one of my $1 million babies. Okay. So this is my other son's policy. So we actually have 3 accounts for him because when I first was introduced this concept, um, my son was 6 months. However, the other company that we use did not have what's called living benefits. Okay. So insurance has evolved throughout the year. So they keep adding benefits, which is amazing because God forbid they get sick, you can take out of the policy. So here we can see, me and my husband were like, hey, we can do another extra $50 a month. So that's $100 a month. Because here, right, I go outside, I spend $100. Okay, just gas, food, right? That's already out the door. But um, we're really big on like budgeting, making sure that we put savings first for our children and for ourselves. But God forbid, knock on wood, he passes away tomorrow. Even though if you only put, let's say, $500 in this thing, the family will get 186,386, and that's tax free. But what I loved about this is because, hey, instead of putting it into a regular savings, because we structured it a way where we're going to put extra money, this will be a $1.9 million asset at the age of 69. As it continues to grow, it'll continue to grow to millions of dollars. And this is why we call it the $1 million baby plan, because you really have, your kids have the opportunity to save now where they can have $1 million asset later. And here at the end, it's like, what if they become ill, right? I work for Adult Protective Services, and what I see is people would um, have big retirement accounts, but when they got sick, they had to deplete all their accounts to take care of them. But here, because we put these in place at an early age, they don't have to worry about that. God forbid if they had terminal illness, this will pay 1.5 million lump sum. It has chronic illness, which will pay $30,000 a month. I live in the state of California, and assisted living is minimum $10,000 a month, which can deplete someone's assets very quickly, right? It has critical illness benefit up to $1 million, critical injury up to 1 million, and Alzheimer's. They just added that up to 1.5 million. So this also gives them a peace of mind, not just savings, but what if, they get sick? We do not know what can happen in the future. So I'm going to show you how I structured my son's policy, right? How it was able to grow into $1 million asset. So at first, we're like, hey, for the first 5 years, me and my husband said we can do $100, but we know in the next 5 years that we're going to increase our income. So we're going to put an extra $100 for savings. So that's 200, that's $2,400 a year. Okay. And then at the age of 19, right? Because my son is already an entrepreneur. He sells lemonade, outside of our house. So he's already getting some income. So we're teaching him how to save. But here we're going to tell him to match what we're putting in. So he's going to put an extra 200, which is going to be $400 a month that we're saving. Okay. And then at the age of 45, we're going to say, hey, we'll stop putting money in this thing. What he has saved is about 147, what we have contributed, but that 147 became $412,000, right? So here, as you see, that his money grew over time. You basically paid for the insurance already. Okay. So And he's not putting any more money into this thing. So we're going to have this thing grow because he has other policies to take out of. But if we continue to just make it grow without putting any more money, at age 60, he will have $1 million in this account. Right? How powerful is that, you guys? Right? And we know he's going to live long, right? So at age 80, he has 3.9 million in his savings. So God forbid he passes away, then his benefit will be $4.1 million to pass down to the next generation. So this is the power of these type of investments, you guys. Just mom and dad decided to start saving $100 a month. But what if you have a young adult, right? So some people on here, they have um older children. Is it too late? Right? No, it's never too late, right? The best time to start was yesterday, but the second best time to start is today. Okay. So we have actually, this is Miss Marlena's client. She helped a young adult who's 23 years old, just started his career, his job. We call him Mr. Start Late because obviously he didn't know about these plans. His mom and dad didn't know about them. So Miss Marlena educated him about what he can do. This young adult is scared because he doesn't think that Social Security is going to be there at the time of retirement. Smart guy, because I don't think Social Security is going to be there in the next 5 years. So we have to plan, right? So Miss Marlena started him off with $150 a month. He has the same benefits, okay? Obviously, he started a little bit later. So God forbid he passes away. His benefit is 167,000. But Miss Marlena actually did this as a lifetime income rider, meaning that we're going to create a social security for him. And with Social Security, does anybody know what is the maximum benefit? Um, what you can get in Social Security? Anyone? So the maximum benefit for Social Security in 2025 is you have to basically retire at age 70, okay? And in order to qualify for the maximum benefit, you have to make at least $176,000. Okay, that's crazy. And you got to work for 35 years. So the maximum benefit that they'll give you is $5,108. That is a scam, right? You work all those years, make six figures, and you only get $5,108. So here, Miss Marlena structured this kind of a social security for him. Here at age 70, he will get more than Social Security because she structured it a way where he can continue to save. He will get 6,579 for the rest of his life. Okay. And it does not run out because there's a lifetime income rider on it. Um, and then he also gets all the benefits. God forbid he gets sick. So, but let's look how Miss Marlena structured this for her client. So here she said, the guy said, hey, I could start at 150 and I know I'm going to get a raise, right? So at year 4, they're going to increase it to 250. The goal of this type of plan is you want to continue to build your savings, okay? Because the more that you build from it, the more advantage you will get. So at age 29, they increased it to 4,200 a year. That's 350 a month. So every year they're increasing it, right? So maximum that they'll increase this to is $6,000 a year, which is about $500 a month. That is the average on what people put in their 401k, right? $250 every 2 weeks. So $500 a month. So he wants to retire early. He wants to stop putting this at age 57. Okay. He has contributed 181,200 in this thing, and that savings became almost $500,000. But he's not going to touch this money, okay? He's going to wait until age 70 to start taking income. So that income will be 78,948, right? And if he lives to 100 years old, this will still continue to pay him out. So as you see here, it can go up to 120. He took out $4 million in this thing, and he only contribute 181,000. God forbid he passes away, right, at 120, then he still leaves a benefit to his family. This is what's called building generational wealth, right? And that's why me and Marlena are so passionate about teaching parents, teaching grandparents that you can you can build generational wealth for your family. So, if you like this information, what are the next steps, right? One, get back to the person who invited you, right? Set up an appointment to structure a plan for your own children, grandchildren, right? And we will help you. We will do what's called a financial needs analysis because it's not a one size fits all, right? We want to know your goals for your kids, and let us help you create your $1 million baby um, children. Okay. So me and Marlena and our team, we do this every single Wednesday, as she mentioned, at 6:30. So if you have any parents, grandparents that that could benefit for this information, invite them to this call. We would love to educate them and educate our communities that you can start something and really build generational wealth for your family. So we thank you guys for being with us this evening, and we look forward to helping you set up your $1 million baby. Thank you, everybody.
Thank you. Enjoy the rest of your Wednesday.